Welcome to our 2025 webinar series, A Universe of Insurance Planning. In today's presentation, we will explore out-of-this-world annuity benefits as we discover the array of annuities available today and how they fit into the sphere of financial planning. We will also review annuity riders to learn how they may enhance a client's financial plan, and we'll also uncover the options for those clients who have annuities they no longer want or need. Today's webinar is being recorded and will last about 50 minutes. You must be logged in the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We will answer all questions as best we can. If we do not get to your question today, you may expect a response by email. The webinar will be posted to our website within 24 hours. Today's presenter joined LLIS in 2008 and has over 20 years of experience analyzing, studying, and researching annuity solutions. Here to present is Jerry Skapiak.
Thank you, Valley. Today we're going to talk about annuities, my favorite subject. And often I get asked, what is new in the annuity world? Well, let me get over here. Still, what is new is interest rates. For so many years, interest rates have been low. In fact, interest rates were dropping since about the 1980s, roughly, or they were going down, and not until the around 2022 range did interest rates finally start going up. As far as annuities go, they kind of peaked around December of 2023. They've come down a little bit, but historically, for how interest rates have been on annuities, they are still relatively high. So today we're going to talk about a couple different kinds of annuities. We're going to look at fixed deferred annuities, immediate annuities, deferred income annuities, qualified longevity annuity contracts, or QLACs. Been a lot of interest in those lately, and indexed annuities. So let's start by talking about fixed deferred annuities. So what exactly is a fixed deferred annuity, or MIGA, as a lot of you may know them as also? What you're getting with them is you're getting an interest rate that is guaranteed for a fixed number of years. You're going to have a surrender charge that is going to match the number of years for the rate period that you select. So, for example, if you go with a 4-year rate, you're going to have a 4-year surrender charge. 10-year rate's going to have a 10-year surrender charge. Most annuities allow you to withdraw a certain amount free because they do have a surrender charge. And typically you can withdraw anywhere from 10 to 15%. I have been starting to see lower free withdrawal rates. I've seen interest only. I've seen them as low as 3%, 5%. Insurance companies are doing that just because they can bump that interest rate up a little bit higher. And for most clients, it's not a big deal because they don't plan on touching the money anyways. So, like I said, these annuities do have a surrender charge. There is just no way around it. Even on a low load basis, they still have surrender charges. And the reason for that is it's serving two purposes. It's going to recoup the cost of commissions paid to agents, and it's going to cover the underwriting expense. Now, there's not underwriting like you would expect, like with life insurance. It's more of financial underwriting, and all annuities have this financial underwriting. Basically, the insurance company is making sure that the annuity is an appropriate investment for your clients. Now, the surrender charge is normally decreasing. There are some annuities that have level surrender charges, but typically they are going to be decreasing. Annuities are retirement vehicles, so they do grow tax deferred. So that means any interest earned in them, the client is not going to pay taxes on them until they start taking withdrawals. And because they are retirement vehicles, The withdrawals are going to be LIFO, so that interest they earn is going to come out first. Basically, the IRS wants to get their money on the interest earned, so they want to tax it. So the gains do come out first and are taxable as ordinary income. And if they are under 59 and a half, they do have a 10% IRS penalty on the gains as they are withdrawn. Over 59 and a half, they don't have to worry about that, but that is something just to keep in mind when clients are looking to invest money in an annuity. So here's where interest rates are today. The 3-year just recently dropped below 5%, but we can still get 5% or more on all of the other rates. I remember, probably 18, almost 20 years ago, when I was first starting to work with annuities, the company I was at used to run a special. It was 5 for 5, meaning you could get 5% for 5 years. And it's been a real long time since we were able to get that again. But it's nice to see those rates up above 5%. That's kind of like a key metric for fixed annuities. I don't see any questions on fixed annuity. They're pretty straightforward. I like to say a lot of times, think of them like a CD, like you would see at a bank. You're just going to get a guaranteed interest rate. Now we're going to talk about immediate annuities, and this is probably the type of annuity we deal with most here. I often get asked, how much money should I invest in an immediate annuity? Well, I always say look at covering a client's fixed expenses. So cover their mortgage, their electricity, water, groceries, and you can't forget about those insurance premiums. So like when you're looking at like what those fixed expenses are that they're going to have every month, and you look at if they have Social Security or if they're fortunate enough to have a pension, if they still have a shortfall, then it's probably a good idea to consider an immediate annuity for them. God gives them a little peace of mind knowing they have some additional income coming in every month that's going to be guaranteed for as long as they live. So with immediate annuities, there are various payout options that are available. You can get period certain, which are non-lifetime or lifetime payout options. So the payout options, a period certain payout is just exactly how it sounds. It is going to be for a set period of time. Now that can be for, anywhere from 5 years up to 30 years. Typically what we see is they're typically used for a 5-year period certain, or basically a time period to bridge the gap from when a client retires to the point when they're going to start taking Social Security. So we'll use a simple example. Let's say the client purchases a 5-year period certain annuity. That annuity is guaranteed to make payments for those full 5 years, regardless if the client is alive or not. If they pass away before the end of that 5th year, payments will just simply continue to whoever they name as a beneficiary. Now, the most common type of payout options are going to be lifetime payouts. And a life-only payout will have the highest payout for your client. It's guaranteed to pay for life, but once they pass away, payments will end. So they could literally purchase the annuity, receive a payment, and then pass away, and the insurance company will keep all that money. A lot of clients don't like that idea. But so what we can do is we can add a guarantee onto that payment, meaning that the annuity will be guaranteed to pay out for a certain amount of time. And that can be, for example, a life and a period certain. So we could do, any number of period certain, 10, 15, 20, 30 years. We'll use a simple example. Let's say a client puts in $100,000 into an immediate annuity, and they choose a life and 10-year period certain. They're going to continue to receive payments for as long as they are alive, but if they pass away, let's say after 8 years, that annuity will continue to make payments for the next 2 years, fulfilling that 10-year period certain part of the annuity, and then the payments will stop. If they live beyond 10 years, great, the annuity will continue to make payments to them. There are two other options, life with installment refund and life with cash refund. These are my two favorite options. These guarantee that the annuity will make payments at a minimum as long as it takes to recoup their initial premium they put into the annuity. So let's go back to my example. Let's say the client puts in $100,000 and they're receiving payments and they pass away after receiving $75,000 of income out of the annuity. The installment refund option will continue to make payments to their beneficiary until the other $25,000 has been paid out, whereas the cash refund option will just write a check for $25,000 to their beneficiary. I like to say, it depends if the client wants to rule from the grave. If they want to rule from the grave, or if they have a spendthrift beneficiary they're worried about, they're going to go with the installment refund. If the person they're naming as beneficiary is responsible, they'll go with the cash refund option. Now, with immediate annuity, whenever you're adding on any type of guarantee on the annuity, it's going to lower the payout. So here's an example of where payouts are. I just ran these today. You'll see for Giovanni, who is age 70 with a $200,000 premium, a life only will pay him $1,453 a month. You go down to a 10-year life and 10-year period certain, that payment drops down to $1,392. Or if you go out to life and 20, it drops down to $1,209, which would be the lowest payout. My two favorite payouts, the installment refund and cash refund, you can see their payouts there also. You also notice there's an exclusion ratio, and this is only for non-qualified money. And basically what this does is this tells us what percent of the payment each month is going to be a return of that original $200,000. So it will be excluded from taxes because it's a return of principal. And so you can also calculate what the taxable amount will be each month. So besides these payouts, we have all these same payouts for a joint. So you can add a spouse on to the annuity, or it doesn't necessarily have to be a spouse, it could just be another person, and the payouts will be based over both of their lives. Just like a pension, you can choose to have the payments reduce upon one of their deaths, but the vast majority of the time, most people go with 100%, meaning that when one of them passes away, the payment stays the same, continuing to the surviving spouse. And here's an example of what the payouts look for Felipe and Janice, age 70 and 72. You see our joint life is $1,260. You don't lose a lot by adding on a period certain. In fact, it doesn't cost much adding on any guarantee to the annuity. In fact, there are times when I run this where, for example, a joint life and 10-year will have a higher payout than a joint life. The reason for this is insurance companies are really trying to get clients to go with a type of some form of a guaranteed payout with it. Simply because insurance companies in the past have been sued by beneficiaries, stating, their parents put money in the annuity and they didn't live long enough to get all their money out. So the beneficiaries are turning around suing insurance companies. So what insurance companies have done is they've modified the payment streams to entice clients to go with some type of guaranteed payout with the annuities. The exclusion ratio. Well, the exclusion ratio is the exception to the rule in annuities where the gains come out first. When you annuitize the annuity, it's going to spread the gains out over the insured's lifetime. And when I say lifetime, that means the IRS calculated lifetime for the client. And so what that does is then each payment is going to be part of cost basis, which will be tax-free, and gains, which will be taxed as ordinary income. Now, with immediate annuities, because they are an irrevocable decision, meaning that once the client purchases the annuity, there's no cash value in them, so they can't surrender them, change their mind. Insurance companies limit how much they can put in to protect the clients against themselves. So for non-qualified money, the maximum amount you can put in is 50% of their investable assets. And for qualified, I'm told you can do up to 100%, but most of the time insurance companies will limit it to the 50%. Even if you have a pro bono case where it makes perfect sense for a client to put a vast majority of their assets into an immediate annuity to increase their monthly income, insurance companies will not do it. I get those, I don't know, a couple times a year with advisors wanting to put excessive amounts into the immediate annuity for clients. All right, next up, deferred income annuities. So what is a deferred income annuity? Well, it's a cross between a deferred annuity and an immediate annuity. It's going to insure your clients against living too long, and it's usually used as supplemental retirement solutions. Now, when I was first working in the annuity industry, I was actually at a company, and we were one of the first ones to come out with one of these products. There was a lot of research done, a lot of studies done with outside consultants on this product to make sure they were going to be a viable solution for clients. And if, as a financial planner, you use planning software that has Monte Carlo simulation on it, if you add in one of these annuities into the plan, you're going to get one of two results. One, either it's going to allow you to increase the withdrawal rate for the client, or two, it's going to increase the probability of the success of the plan. So that was one of the big aha moments when they were doing the research when developing this product, seeing that it did this for clients. So what are the features of deferred income annuities? Well, first off, they are single premium only. You cannot make multiple payments into them. You can only use a single premium. They're going to guarantee an income stream that's going to start 2 to 30 plus years in the future. So basically, you have to defer these annuities for at a minimum 2 years, and you can defer them out all the way to age 85. And the payout options are very similar to what you would see with an immediate annuity. There are no lump sum payouts. They are only going to pay out on a monthly, quarterly, or annual basis. Most commonly, it's going to be monthly. You can add on a death benefit to this. And what the death benefit does is it basically means that if the client passes away before they start receiving payments, remember, we're deferring these payments 2 years or out to age 85. Most of the time it is deferred out to age 85. That if that client passes away before those payments begin, the insurance company will simply refund the premium to the beneficiary. And we'll take a look at how much it costs to add this rider to the annuity. And then the taxes, well, remember I said this is a cross between a fixed deferred annuity and immediate annuity. So taxes are going to be held off until the client starts receiving payments. So these annuities do earn interest rates. I have no idea what the interest rates are they are crediting on the inside. They do not publish that. But they are earning interest rate, and all that grows tax deferred. And then once payments start, that's when the client will start paying taxes on the gains of the annuity. So that's deferred income annuities. Qualified longevity annuities, or QLACs. I've been getting a lot of interest in these lately. They're very similar to deferred income annuities, except one, you can only put in a maximum of $210,000 into these, and you can only put qualified money in them. No Roth money is allowed to be put in them. Same as the deferred income annuity, defer payments up to age 85, minimum of 2 years. And you have two payout options only: life only or life and cash refund. Those are the two payout options only available with the QLACs. There's no lump sum payouts. We can add on a beneficiary like we can with the DIA, and taxes are only paid when payments are received. And what's the big thing why I believe there's been so much interest in these lately is because the value is excluded from RMD calculations. So when you have clients and they're getting to 70, 72, and they're going to have to start taking RMDs, they don't need any more income, but now they're being forced because of RMDs to increase their income. You can help reduce that taxable liability by purchasing a QLAC. You can move up to $210,000, and this can be for each spouse, assuming they each have qualified money. You can move it to these and help reduce the taxes. So here's a sample of where payouts are today. Here we have Leo, age 65, $100,000 premium. We're looking at payments beginning at age 85. Now you can see here, with a death benefit for a single life, the payment would be $4,796 a month. And this is once again starting at his age 85, so we're deferring 20 years. Without the death benefit, the payout is $5,801. So there is a cost to adding that death benefit to the annuity, but a lot of clients feel more comfortable having that death benefit added on to the annuity. In fact, the vast majority of DIAs and QLACs that are purchased by clients have the death benefit added on. And you can see single life with cash refund, it's costing, either way you look at it, about $1,000 a month adding on the death benefit. All right. And the final annuity we're going to take a look at is indexed annuities. Now, I will say up front, not a huge fan of these products, except if we're going to use them for income. There are some nice ones that have income riders on them that can produce nice income. But when we're looking at them, we're looking at what is only guaranteed in them and not looking at some outrageous performance numbers that some of these illustrations can show. So what is an index annuity? Well, its performance is tied to a particular market index, but not directly invested in the market. These are fixed deferred annuities. They are using a benchmark index to calculate what the interest is going to be. Most common index used is the S&P 500, and typically these products have a cap of how much the annuity can earn, and there's also a floor where you can get 0%. Now, there are some newer versions of these products that are registered where the client can actually lose money. To me, they are the most complicated annuity products out there. I have yet to come across a client that's been shown one and can explain it to me what they've been showing. All right. So here's a proposal that we were given. I like using this one, even though it is old. It's just to make a point. This was ran in 2009. They're projecting forward using the last 10 years at the time to show you what the return can be in these products. And if you look like right off at 2009, the S&P 500 returned 23.45. But because of the cap of 6.85, they only were credited 6.85%. But what clients like about these annuities, if you look at 2011, 2015, and 2018, the S&P 500 either earned 0 or had negative returns. Clients like them because they don't lose any money in those years when that happens. Whereas if they were in, let's say, a variable annuity or just invested in mutual funds, they will have lost money at those times. But they also miss out on a lot of the market upside with the products. And in this case, had they actually been invested in the market, they would have had slightly over 200,000 in their account, whereas since they were invested in the index annuity, they only had 159,000. And the same annuity, same proposal, looking at the worst 10 years of the annuity, you can see that we have a lot of years here. We have a bunch of negative years here where they earned zero. They didn't lose any money those years. We have a good year here in 2003. So it goes, up and down, not up and down, but it goes up only. They didn't lose money in the bad years, especially like 2008, where it was negative 38%. Being in the annuity, they managed to have 138,000 in it, but if they were actually invested in the market at this time, they would only have 73,000. So there's some pluses and minuses to it. As advisors, you're generally able to help mitigate some of these swings for clients' portfolios by having them invested in the appropriate markets. Now, with these annuities, there are no costs that you see. Like a variable annuity, you're going to have various costs that are tied to them. A pure index annuity does not have any cost associated with it. But what I like to say is there's a hidden cost in the annuity, and we've kind of seen some of it here. Sorry, lost my place. We'll get back to that in a second. With these index annuities, they're designed to protect against the downside, and this is why clients are purchasing them. But you got to read the fine print on them when you're looking at them. They're going to tell you what the guaranteed minimum cap's going to be on the annuity. This one at the time was 1.1%. When we ran it on 9/5 of that year, the cap was 6.85. We ran it a couple days later, and the insurance company already reduced the cap. So, that's one thing with these annuities. Just because you have a cap that's nice when you purchase it, insurance company is going to change it every single year when the index renews. So we know what it is today, but what is it going to be in 5 years? There's generally no motivation for insurance companies to really keep them as high as possible, especially on the older annuities. So it's just, you just have another variable that's added on in the annuity. So now this is where I was going with hidden cost. This is like a statement that was sent to me this year. This is their ending balance this year, but I want you to look down here at the bottom. It had a cap of 2.75%. The index returned 21.11%. They were credited 2.75. To me, that is the hidden cost of these annuities, is not really being able to participate in the market when it's doing really good. All right, so that's it, kind of going over the basics of some of the annuities out there. I am asked to review annuities almost every single day for advisors. As you're bringing on new clients, or clients find something in the filing cabinet, these existing annuities they have, most advisors are not familiar with them, not really sure what to do with them, so they send them to me. So I want to go over kind of briefly here, like, what do I look at when I'm reviewing an annuity for your clients? So there's a couple different things I'm looking at. I'm looking at surrender charges, is it qualified, non-qualified, cost, client's age, death benefit, does it have an income rider? And we're going to spend a lot of time going over the income riders. And how do I come up with my recommendations? All right. So first thing I'm looking at, does the annuity have a surrender charge? If it does, there's not really much we can do with it. I can't recommend a client surrender an annuity, get out of an annuity when it has a surrender charge. But I should be able to give you information for you to make a determination if it's in the client's best interest to pay a surrender charge. to get out of annuity when you compare it to the cost that they may be paying inside that annuity. So if there's a surrender charge, I typically say just hang on to the annuity until the surrender charges are over. But if there are no surrender charges, we can move to step 2. Is it qualified or non-qualified? So if it is a qualified annuity, okay, and there's no surrender charges on the annuity, you can just roll that annuity to another qualified plan where you can manage it for them. Now, if they're looking to get income from it, or if it has an income rider on it, maybe don't be so quick to move the money out of it. We need to look at it more. If they're looking to get income out of it, let me run an immediate annuity quote for you. It may make sense for them to annuitize that money. I know a lot of advisors see annuity, they just automatically want to get clients out of them. It's not the cards you would have dealt to the client, but they are coming to you with them. So we got to look at what's the best use of them for the clients. And it's not always getting the clients out of the annuities. We talked about that. All right. If it's a non-qualified annuity, well, we need to determine the overall objective of the annuity. If you have a high earner that's in that top tax bracket, the income deferral they're getting with the annuity, it may be a good investment for them because of that tax deferral. Or the overall investment strategy, makes sense to them because of that deferral. They may get access to some funds in there. Like I know we have some dimensional funds that are in some of the variable annuities that your clients may not get access to another way, but we can do it through a variable annuity. If it's not qualified, we also need to look at the basis of the annuity. So if it's an even basis, so basically meaning that the premium they put in, the annuity really hasn't grown at all, so it's about equal. So they're going to basically pay no tax or a small tax if they surrender the annuity. You can surrender it and reallocate the money. I once had an advisor that the client had a $2,000 gain in the annuity, and they wanted to roll it to another annuity so the client didn't have to pay taxes. And I started explaining to them, if your client's in, let's say, a 20% tax bracket, they're going to pay $400 tax on that annuity. And to get them out from underneath the umbrella of an annuity to do other investments with it, to me, it's worth paying that little bit of tax to get them out and move on away from them. If there's a large basis in it, well, then we can look at 1035 exchanging to another annuity, maybe get them lower cost, or wait for those values to grow up to the basis. So when you have a large basis on an annuity, meaning that your cost basis is greater than the account value, if you just surrender that annuity, I am not a tax professional, but what I've been told is you cannot write off that loss. So you can move that money to another annuity that may perform better and have it grow up to that original cost basis and then surrender it. So now you're going to gain, you'll get some gain out of that money without paying taxes on it. And if there's a small basis and a large gain, which is typically what I mostly see nowadays because the market has performed well, if there's a large tax bite, if surrender, well, then we got to move to step 3 and do some more evaluation. And what's the cost of the annuity? Well, depending on the type of annuity, they may have mortality and expense charges. There may be administration charges. There could be rider charges on it, and there could be sub-account fees on it. And these fees can total anywhere from a little over 1% to over 3% total on an annuity. So we need to evaluate that and see what they are. Step 4, what's the client's age? Well, are they under 59 and a half? If we're thinking about surrendering an annuity, well, we may want to wait a little bit to get them to 59 and a half so they don't have to pay that 10% penalty on the money when they take it out. Step 5, death benefit and income riders. So, is there a death benefit on the annuity, and is it higher than the current values of the annuity? Well, not so common today anymore, but older annuities, 10 years or more, like a big thing was adding on what I call enhanced death benefits onto the annuities. And what these did is like they may grow the death benefit by a certain percentage, is typically what I've seen. So if you have an unhealthy or older client, it may make sense to keep the annuity just for the death benefit. Because let's say we got an example here. Let's say the original annuity has a cost basis of $100,000. The current value of the annuity is $200,000, but the death benefit is $250,000. So the client could surrender the annuity, get the $200,000, and that's what would be passed on to the beneficiaries. But if they hang on to the annuity, they're going to have that $250,000. Now, the death benefit on an annuity is not like a death benefit on a life insurance policy, where life insurance, the death benefit is paid tax-free to the beneficiaries. With an annuity, it's not like that. So the cost basis will be paid to the beneficiary tax-free, and they will have to pay taxes on any amount over that basis. But as a beneficiary, I would rather pay taxes on $150,000 extra, so I get that extra $50,000, as opposed to just receiving $200,000 if the owner of the annuity had just surrendered it. So in the short term, it may make sense keeping the annuity, but that needs to be reevaluated periodically, because as the cash value grows or the account value grows in that annuity and it approaches or gets closer to what the death benefit is, the death benefit value kind of decreases in the annuity, or what the value of it can be in the financial plan. So that's just something that needs to be watched. Take a look at the annual statements and just see what's going on with it. All right. So the big thing is, in almost every annuity I review, and when I say almost, I mean probably 90% or more of the annuities I review, are going to have an income rider on them. So what is an income rider on an annuity? Well, it's a rider that's going to guarantee the client some income. And there's two different main types. There's a guaranteed lifetime withdrawal benefit and a guaranteed minimum income benefit. The GLWB is by far the most common one. The GMIB was really promoted by one insurance company out there, rather large insurance company, but still not as common as the GLWB. So let's take a look at some basics for income riders. So when you're looking at a statement for a client, you're going to see a couple different values on that statement. You're going to see account value. That's the real money in the annuity. That's their money. That's their money that they can spend. That they could surrender an annuity, they're going to receive that money. And then you're going to see another number often referred to as benefit-based. Some other companies may call it something different, but most companies call it something similar to the term benefit-based. That's the funny money in the annuity. That is just a number on the statement that is used to calculate the income. So let's use a simple example here. Client wants to invest $100,000 into one of these annuities, and that annuity is going to guarantee them 5%. All right. So clients hear that. I'm guaranteed 5% in this annuity. So client purchases this annuity. At the end of year one, the account value is $103,000. But they're guaranteed 5%. Well, what's guaranteed to grow at 5% is that benefit base. So at the end of year one, that benefit base is actually worth $105,000. We go to year two, account value does great, grows to $120,000. They're guaranteed their 5% on that benefit base. It grows to $110,000. What is nice with these annuities is they have a feature called a step-up feature. And what the step-up feature does is that on any policy anniversary, now some companies may do it quarterly, monthly. There's one company that does it on an annual basis. But basically, they all work kind of the same, that whatever their trigger is to do this calculation, we're going to use annual in our example. If on the policy anniversary, if the account value is greater than the benefit base, that benefit base will step up to equal the account value. So at the end of year 2, our account value and benefit base are both worth $120,000. Year 3, account value goes down, don't have such a great year. Our benefit base grows by its 5%, is worth $126,000. Client says, this is great. I want to surrender this annuity. It's done great. I want my $126,000. Well, they don't get the $126,000. That is only used for calculating income. If they want to surrender it, they'll get the $80,000. So let's go back and now let's talk about our 2 riders. Our guaranteed lifetime withdrawal benefit. This is not annuitizing an annuity. It is a withdrawal benefit. And basically with this rider, it allows the client to withdraw a certain percent of the benefit base every single year. The GMIB typically has 2 options. One, it will allow them to withdraw 5% of the benefit base for life. Or they can annuitize that benefit base, giving up control of the money in the annuity and receiving a slightly higher income than if they just did a withdrawal benefit. Now, what's nice with the withdrawal benefits of the annuities is that their account value is still there. They can always take the money out of the annuity, take more money out of the annuity. They have that option, but it will affect the annuity going forward. And we're going to go do an example of that in a moment here. So here we have our GLWB, and typically with these riders, the older the client is when they start taking income, the greater the percent they can withdraw out of the annuity. So in our example, our client's going to be age 70. They're going to take withdrawals out of the annuity, so they're going to get 5.25%. So we're going to go back to our example. Here we have year 3, $80,000 account value, $126,000 benefit base. So our client can withdraw 5.25% of the $126,000, allowing them to withdraw $6,615 a year. So here I have an example, just simple math. We're not factoring in any additional growth of the account value or decrease of the account value. I just want to make a point with this. So year 4, our client's going to start taking the withdrawals, and you'll notice that their $6,615 withdrawal continues every single year. You'll notice that their account value goes down by that amount. So what I want everybody to look at here is year 16. Our client's been taking withdrawals of $6,615, and they no longer have any money in the annuity, but they continue to receive their income. Any client of yours that has an annuity with an income rider, this should be their ultimate goal, to live long enough with taking withdrawals that they have depleted the account value. It is at this point, they've paid fees all these years in the annuity, that the insurance company is finally on the hook to continue to provide them that income. If this is not their goal, they want to be able to leave money in this annuity to their kids, they are in the wrong annuity. With an income rider on it, the whole goal is to live long enough to take all their money out of their annuity under the income rider so that the insurance company is on the hook. So because that's the goal, insurance companies will entice you, I'm going to back up here a little bit, to wait later in life to start taking money out because they're going to say, well, we're going to let you take more money out. We're going to guarantee it more. But the one thing we cannot change is how long the client is going to live. So what I always recommend, clients should start taking money out of their annuities that have income riders as soon as they are able to or as soon as they retire in hopes of living long enough to withdraw as much money out of the annuity as possible. So the GLWB, it is a withdrawal benefit, so the client has access to that account value in the annuity. So what happens if they want to take more money out of the annuity? So here we have our starting point, $80,000 account value, $126,000 benefit base. The client says, you know what? I want to withdraw $40,000 out of the annuity. And they absolutely can. They have the right to do that with this rider on the annuity. But it's going to have implications on future income. With these riders, whatever additional amount you take out of the annuity is going to reduce your benefit base proportionally. So in our example, we're going to take 50% of the account value out of the annuity, which means we're going to reduce our benefit base 50% also. So very simply, in year 4, instead of taking $6,615 out, we take $40,000 out of the annuity. That changes our numbers, reducing our income to $3,308 every year. And then that continues as before. Now it takes to year 20 to deplete all the money out of the annuity, but the annuity continues to provide income. The GMIB income benefit is the other rider. So it has two options. One, withdraws up to 5% of benefit base, works just like the GLWB, except no matter what age you start taking withdrawals, normally they have a minimum age that will allow you to start, you get 5%. The longer you wait, you don't get greater than 5%. Or you can annuitize the annuity, but that involves giving up control of the annuity. So we go back to our example. Here, client can take 5%. They get $6,300. They can withdraw for life. Or if they want to do option 2, typically they have to wait 10 years to start taking money out. If they elect a step up with it, it starts a new 10-year waiting period. Typically, there's an age setback the insurance company will enforce when calculating what the income is going to be. So with immediate annuities, the younger you are, the lower your payout's going to be. So basically, if you have $100,000, a 65-year-old is going to receive less monthly income than a 70-year-old. And they don't put on the statement what you're going to get if you do the annuitization route. So you got to call the insurance company to get that payout. So this is just an example. In this case, back in time, they would have been able to get $7,056 a year if they annuitize it. So it's about $700 more a year, but they are giving up control of the annuity. All right, so final thing, recommendations for the annuities. Qualifying money. So without an income rider, roll the value of the annuity to an IRA once surrender period is over. There is absolutely no reason to keep the money in an annuity, pay whatever fees there are in the annuity, move it, you can invest it in low-cost funds. With an income rider, if the annuity will be used for income, you may want to keep it. We kind of covered that, going over why it may be beneficial. If they're not going to use it for income, then just roll it to an IRA once surrender charges are over. Qualified annuities are the simplest ones to decide what to do and not do with. Non-qualified annuities. Well, if there's a little gain or a loss in the annuity, surrender the annuity once the surrender charge period is over. Client's going to pay taxes on any gains there are in the annuity. If, like I said, if they're in a loss or there's a small gain, just get them out of the annuity, pay whatever little bit of taxes there are. Non-qualified annuity with little gain or loss with an income rider. Well, if the annuity will be used for income, they may want to keep it. It may be a good rider to have. Some of those older riders on the annuities are not really that bad for income, just assuming the client's going to use it for income. If the annuity will not be used for income, then once again, surrender it once the surrender charge period's over. Non-qualified annuity with a large gain. Well, now we have all kinds of options that we can look at. Well, we can annuitize or transfer it to an immediate annuity. We're going to get benefit of that exclusion ratio if we annuitize it. We can 1035 exchange it into a no-load annuity, reducing the fees of the annuity. We could do 1035 exchange to fixed annuities. Say the client's tired of the ups and downs of the market and they just want something a little more level. We can look at a fixed annuity. We can even look at a hybrid annuity that has long-term care benefits with it. So remember, we're looking at non-qualified annuity. Hybrid annuities have to be non-qualified. And if there is an income rider on it, well, they may want to keep it for future income. Oops, I don't know how I jumped all over. And that's all I have for the annuity aspect. These are the conferences. We're going to be going to the normal ones that we do every year. We'll be at NAFA Spring, Garrett, XYPN, ACP, and NAFA in the fall. We will be having our webinar sessions again next year. We're still working on them, putting them together, or at least the subjects we want to cover, but stay tuned. We'll be announcing that sometime next year for you. Any questions? I don't see any that have come in. So since I don't see any, thank you everybody for attending, and have a good night.